If you have questions for Ben, go ahead and raise your hand digitally and I'll call on you to mute yourself. Muhammad, you just raise it physically. I just happen to see it, but usually I can't see it. Go ahead and unmute yourself. But for the rest of you, raise your hand digitally and they'll line you up to be able to ask Ben any questions you want. Can't hear you. And now I can see you talking, but I can't hear you. You have to unmute.
This is a good
Oh,
question too.
you can, if your audio doesn't work, Muhammad, if you can just type it into the chat, we'll take it on from there as well. In the meantime, anyone else have questions for Ben? And we'll talk about really good stuff today. All right, while they're doing that, Ben, since you mentioned podcast is the, yeah, other going on other people's podcasts and then the investor luncheon or meals, dinners. The podcast, do you try to, what are some of the niches that you try to go into? I assume it is not all real estate niches, right? You go into finance and business and such. What are some of the major niches that you go into that you have found to be good to attract passive investors?
Yeah, these days you can find a podcast on anything. There's all sorts of
Yeah.
categories out there. So, yeah, it is the real estate finance focused podcast for sure. There's a lot of alternative investing podcasts. I found a lot of success. There are CPAs who have podcasts. So here's the little secret. Sometimes these CPAs, they have a couple hundred or thousand listeners, right? And they're talking about tax strategy. And you can go on and just basically talk about MH in general, not even pitch the fund. Just say, hey, I've got this fund to the side. Here's our return profile. Not really a pitch. And that has done really well for us. And it's like some of these CPA firms we've just reached out to and said, hey, could we be on your show? Could we do a podcast exchange? You could come on our show. Or sometimes we'll say, hey, we'll give you $500 if we could be on your show next week. And that's worked really well for us. I really enjoyed that.
That's awesome. I love that. Yeah, there's a tool that I like to use and it'll let you guys know more about the podcast, but it's called listennotes.com. It basically it's like a data of all of the podcasts around the world and you can search and sort and all kinds of things you can do with that and get the podcast host's contact information to reach out to them as well.
I love that.
Okay, let's go to, do you work with investors overseas?
Yes. So it's a lot easier if they have a US tax ID number. So they can be a foreign citizen as long as they have like a US LLC or tax ID number. That makes it so much easier. But the short answer is yes, we do.
So
Go
if
go
they
ahead.
have the tax ID number, what do you do with them? Is it better for them to form an LLC, or is it better, like what do you find that is the easiest way to handle that?
Yeah, that's a great question. So if they do not have a US tax ID number, then technically the fund itself would have to withhold. It gets pretty complicated tax wise. And while we bear the expense of time in dealing with that, we would ask the investor to cover the expense of some of those withholdings and things like that. So it is far easier and I would say better to match your language here to just set up a US entity. Simple LLC, Delaware, Wyoming, a couple $1,000 to do, but certainly worthwhile in the long run.
So you recommend them to open an LLC or entity so that they have their own EIN number and you work with them that way?
Yeah.
Because I have a project, I did not know some of them are foreigners until afterwards. Because I totally
Yeah.
thought they live here for that many years, they are American. And then when I do my
Right.
tax, my goodness, so many of them are foreigners.
So if they have green cards, they've got a tax ID number. If they do not have a US tax ID number, then I would say to you, be very cautious of just the time and the expense that it's going to take you to withhold for their taxes. It's going to be significant. That's a big lift.
Yeah.
Okay. It's good to know because I didn't know that before. And now I would learn to ask them, are you guys foreigners?
Wow,
Thank you so
interesting.
much.
Yeah.
It's been very informative. Thank you, Ben. Thank you, team.
Yeah.
Cool.
Can I ask a follow-up question, please?
Yeah, go ahead.
Yeah, the question was if we open a LLC, whether it is Wyoming or Delaware, then how does it help? They get a EIN and they invest under that. Is that how it is?
Yeah, so from my view, I've got to put all the asterisks on this, right? I'm not a tax advisor, tax professional, international, none of that. I just know from experience, it is a pain to do that withholding process, and the amount of legal that you've got to set up for those accounts is significant. We have done it before. It is a significant lift. When a non-US resident sets up a US tax ID number, then the IRS has direct communication or a direct pulse on quote unquote that investor, right? So it significantly minimizes the amount of legwork that we have to do in-house. I'll just say it that way. I'm not sure I could speak in more detail, more substance there on that, but the other side has just been a lot of work before.
Thank you.
Yeah, in CB's case where they live in the US, he should be able to create an LLC fairly easily. Because I've even seen people with tourist visa able to get LLCs here. So I would assume that's an easy process. So yeah, check into that. Randy, go ahead. Good seeing you on here, Randy.
Yeah, good. And thanks so much.
You're breaking up. We're hearing
Oh,
pieces of what you're
my
saying.
apologies. Is that a little better?
Yep. Yep.
Very good. So yeah, I just moved over from multifamily capital raising over to mobile home park raising, and I am absolutely shocked how much easier it is to raise capital with a good track record mobile home park operator than it was in multifamily. Have you found that as well? Because I know you've had a similar background going through that.
Yeah,
Think
that's
it's easier to raise here too?
such a good question. And the answer is yes. Yeah,
Okay.
I'm still shocked by it.
Yeah.
It's been years, and even still, I'm shocked by it. But I think the fundamentals of MH are so strong, and everyone realizes the affordability crisis that we're in, the housing shortage that we're in, the logical steps of this asset class is not going away. It's the most attainable rung on the affordability ladder. Like all of those dynamics, and in not owning the homes yourself, like the headaches that we have are relatively small, still headaches, I would say, but relatively small in comparison to the big multifamily properties that are out there. So yeah, we love it for that. And I'm shocked even still, yes, to how compelling the case is and how that motivates folks. I think you're exactly right, Randy.
Awesome. And yeah, I wonder if I could get your perspective on direct investment versus fund investment. I know you guys do funds. Why have you guys chose to do funds versus direct investment?
Yeah, scale is the answer for us. We are a fully vertically integrated shop. So we've got about 200 employees across 31 states today.
Wow.
And our sweet spot is we're aggregating, we're buying from mom and pop, getting those assets hyper efficient and selling in large portfolios upstream to big real estate shops or big PE. And we get a premium for that. So one of the reasons that we've been able to deliver the returns we have is because that is our model, that kind of slide value add and aggregating and selling upstream. It's more traditional private equity. And our strategy is not for everyone, right? There are people who are saying, hey, I want income. I want to buy and hold. I'm looking for diversification. So I like MH. It's different than what I've got. And I don't want you guys to sell the assets. I want to hang on to it for forever. That's not going to be us. I'd love to send them to you if you have assets like that. The short answer here for us is we've got very, very large funds because we're trying to get mass and we're trying to roll up. That's where we stand out.
Okay, that makes a lot of sense. Thank you.
You both gave me a mindset shift today about the fact that it's easier to raise for mobile home parks than it is for multifamily. To me, I thought multifamily is the easiest thing to raise for because of how much exposure it gets. Everybody understand they live in an apartment at some point in their lives. And being here in Texas, like I have this negative connotation of mobile home parks because most of them are run down and not very nice parks. And so for you both to say that, oh, it's so much easier to raise for mobile home parks than it is for multifamily, it just occurs to me that the marketplace needs to be educated by that. And because I bet a lot of people are thinking like I am. And it's one of the reasons why I just stick with raising for multifamily is because anyone I talk to understands multifamily, they understand apartments. So it's good to hear that. And yeah, both of you are now responsible to educate our marketplace, educate all the fund managers that, hey guys, it really is a lot easier to raise for than multifamily.
Yeah. Randy, it really is such a good point. I'm still surprised by it, but especially when you're coming from multifamily, it's not that far away, right? People still need a place to live. So the logical jump is more of a hop than it is a leap. Very different than jumping over to oil and gas or look at some of these industrial offerings or office conversions. It's like some of that stuff that's a bigger gap to overcome. Mentally, it's not that big of a gap. You look at these yields, and to your point, track record really matters. When you've been able to perform and have a track record here, what we're seeing, Tim, you're talking about the group and the community. We found so much success in partnering with fund managers. And I'm not going to say it's easy for fund managers to raise, but all of our fund managers who have raised for Fund 4 here have been so surprised at how quickly that capital's come in because their folks are already in the headspace of providing housing. They understand housing, they understand the market dynamics, but they want diversification. Maybe they've seen multifamily deal after multifamily deal, and they just want something a little different. And I think that's been a pleasant surprise to their investors, to the fund manager, and we love to see it as well.
Yeah, and I think it's interesting where multifamily obviously got in trouble with this floating rate debt. That's where everybody got hurt. And that was not as prevalent in the mobile home space. So you didn't have as many operators in the mobile home space that got in trouble. So just by that single piece, track records look stronger because they don't have that feather in their hats. Yeah, great stuff, Ben. Tim, thanks for having us or having me. Let's ask questions.
Randy, thanks for that input. Bill, go ahead.
Hello, Ben. I was interested in your whole conversation about mobile home parks and how you own the land and you get rid of the rest of the problem. I'm out here in Boise, Idaho, and I see a pattern of something happening here. I wanted to run it by you and see if you've looked into it. And that is car washes, where you can depreciate the land underneath the car wash pad. I'm seeing private equity coming in here and developing, like 3 or 4 companies came in. They all had their own brand name, their own car wash. All the car washes look like they're the same materials, same structure, drive through, vacuum your car out yourself, finish wiping it yourself, and down the road you go. They have an annual or a monthly fee. Now, what I'm seeing is there isn't 4 of them anymore. It's getting down to 1. Group is buying everybody out and creating where you can go anywhere in the city and there's one of your car washes that's conveniently around the corner. Pretty nice for the consumer. They're only charging $37 a month. I can go in every day and wash my car. It's a hell of a deal. Have you ever looked into that as an investment?
We have, and we're pretty adamant about staying in our lanes. We already have a dual focus of MH and self-storage, right? And we're 80% MH, 20% storage, so small percentage storage, but we don't want to oversaturate ourselves here as far as what the funds are doing. I've looked into it personally, and I know a lot of groups that are doing this exact thing. And when you're talking about this space getting consolidated, it is getting consolidated all over the country. And while that price tag might look pretty good right now, if there's 1 or 2 operators that are owning everything in your town, that's slowly going to potentially tick up over time and just do the normal PE thing, right? They're tied to earnings. They got to continually grow. And there's only one real way to do that. So for us, I think there are some markets out there still that have a lot of room. I don't know about Boise. I know about Kansas City, right? Being from KC, there's 2 or 3 groups that are here. There's probably a little bit of room left, but we're almost oversaturated.
Sure.
And I'll tell you, to compare this to another asset class, storage, you see what the public markets and private equity has done to storage in major metros. Tim, I got to pick on Houston. I got to pick on Houston a little bit. This market is oversaturated. Public storage, life storage that's come in, and private equity has consolidated this space. They need to clip a 4%, 5% yield. Now I'm going on a rant. Bill, you got me on a rant about something else. But
About that?
they need to clip a low yield. So they're sitting on cash, right? Everyone's investing into this stock because they think it's real estate. They have to deploy that cash. They will overpay for product. They need to clip a 4 or 5% yield so they can bring occupancy down, they can bring rents down, and it's destroying markets. And I think something similar, as weird as it is to say, I think something similar is on the horizon for car washes as well. It might take 5-7 years, but I think we'll get there too, just because the space is already becoming oversaturated and consolidated, unfortunately.
That's a really good point, Ben. I'm definitely seeing it here in Houston for sure. Thank you. Okay. Any last question? Jay, so what is the actual opportunity now in Houston? Houston's still a very strong growth city. And also too, like Houston was so big that you can't speak about Houston in general in any way for any asset. You gotta go down to the submarket. Yeah, it's just a unique city. You can have one spot that would be super prime for car wash, and you walk down a couple blocks and it would be bad. And it's kind of weird how Houston is. But yeah, there's definitely lots of opportunities. Just make sure that whatever asset you dive deeper into the submarket within Houston regarding that opportunity. Bill, I assume that's an old hand raised, is that correct?
Yeah, let me get rid of that.
Okay, thanks. All right, Alice says, is there a class that's easier to capital raise within multifamily location and age? Ben, you want to answer that question?
Yeah, so it depends on, man, there are so many factors here. It depends on your investor base and all that stuff. I think it's easier to raise on the surface if you're just going in new to raise for an asset that has in a compelling market. It's
Yeah.
newer, so it looks nice. We can't discount how much pictures change the game and how something looks psychologically to an investor. They don't want to invest in something that's got a hole in the wall, right? They want to invest in something that looks nice. Even if it's a little bit older, but it's well maintained, I think that it's easier to raise for. And then the fundamentals, as far as where are you going to take, this is the thing that's the most important. Here's where we're at today. Where are we going to be at 5 years from now? Where are we going? What is the business plan? And it doesn't matter. Let me zoom out. It doesn't matter what asset class, what asset you're looking at, what asset class you're looking in. Do you have a compelling business plan to add value and to capitalize and to extract that value, right? And can we analyze the amount of risk that you're taking to add that value and the amount of return that you're getting in exchange for that risk? It's a simple equation for folks, and really making it as simple as possible for people. Here's what we've got in front of us today. And I think assets that maybe look a little bit newer, but also have room to add value or extract that value, and putting that risk profile on display as well.
Yeah, for sure. And I definitely second that. It's always easier to raise for class A's and B's than it is for C's and D's. It's always easier to raise for major metro than it is in the smaller metros, secondary, tertiary market. It's always easier to raise for, especially if you're partnering with an operator and you're doing fund of funds. The more experience they have, the bigger the track record they have, the easier it is to raise for. And so you stack all of those things in your favor, and the whole thing becomes easier to raise for. Very good. All right, Ben, we're going to go ahead and wrap up this part of our show today, and then we're going to put people into breakout sessions here. Really appreciate you coming on our show today and sharing with us all of your knowledge and experience. Thank you so much for joining us today.
Yeah, Tim, thank you so much. What a great group, and just a treasure chest full of insights, knowledge, and wisdom here. So really appreciate being a part of the group.
Thank you. And to reach out to Ben, it's ben@crystalviewcapital.com. Go to crystalviewcapital.com. They have tons of different resources on there for you guys to check out. At a minimum, check out their marketing from their website. So if you see their meta ads, take a look at it. Yeah, it's good to study. Ben is like very experienced at this game. He knows what he's doing, and so it's good to follow along and study from him. So let's take a group picture real quick before we let Ben go and we do our breakout session. You guys turn on your cameras. Let's do a group picture real quick. All right, everybody turn on your cameras. All right, Ben, we flex for our group pictures on the show, buddy. Come on, show us. All right, you guys ready? 3, 2, 1. Yay!